I am OG John Original, and tonight we are tracking a series of seismic shifts in global finance and international security that occurred over the course of the weekend while major precious metals exchanges remained closed. Before we analyze the documented events of the past 48 hours, viewers are encouraged to type the words "currency archive" into the comments section, as the information we are about to cover is expected to affect every market position held before the current week concludes. We are monitoring 4 distinct but deeply interconnected developments that have emerged outside of previous reporting. At the forefront is a documented, coordinated withdrawal by the Chinese banking system from paper precious metals exposure. This systematic retreat reached a critical point on March 1st when Zhaoshang Bank issued an explicit notice through its mobile banking application. The bank warned customers that it reserves the right to temporarily freeze trading in accumulated gold accounts in the event of what it termed significant abnormal volatility or liquidity depletion. This development is not an isolated incident. Rather, it represents the latest chapter in a 60-day sequence of restrictive measures taken by China's largest financial institutions. Simultaneously, the geopolitical landscape has been radically altered by a large-scale military operation in the Middle East. On Saturday, February 28th, coordinated strikes targeted military installations and government buildings across 24 of Iran's 31 provinces. Iranian state media has confirmed the death of Supreme Leader Ayatollah Ali Khamenei. These strikes have led to the effective closure of the Strait of Hormuz, a critical maritime choke point through which a substantial portion of the world's oil supply flows daily. As the financial world prepares for the opening of the COMEX and subsequent global exchanges tonight, the convergence of these banking restrictions and the sudden escalation of conflict has created a profound structural dislocation. We begin our detailed coverage by examining the specific timeline of the Chinese banking sector's maneuvers leading up to this moment. The strategic withdrawal by the Chinese banking system began in mid-January and has progressed with calculated precision. On January 12th, the Postal Savings Bank of China ceased the opening of new personal precious metals accounts through the Shanghai Gold Exchange and notified existing customers that their positions would be forcibly liquidated by March 13th. This signaled a definitive exit from the accumulated gold business. Following this, between January 19th and January 28th, several major institutions, including Zhaoshang Bank and the Bank of China, increased the minimum monthly contributions for these products. These adjustments effectively filtered out smaller retail investors, concentrating the accounts in the hands of high capital holders. By January 30th, the Bank of China issued a formal risk warning, reserving the right to suspend all transactions and physical deliveries if massive redemptions occurred for 2 consecutive days. This was followed by ICBC imposing weekend trading limits on February 7th, preventing customers from initiating purchases or redemptions during the exact window when major geopolitical events typically occur. The restrictions intensified throughout February as multiple banks, including the Agricultural Bank of China and China Construction Bank, raised margins for deferred delivery trading to 100%. This move effectively eliminated leverage, requiring investors to post the full value of their positions as collateral. Furthermore, China Construction Bank halted all accumulated gold trading for an 11-day period surrounding the Spring Festival, locking customers out even while the Shanghai market remained open. By February 26th, physical gold bars were reported as completely sold out across the branches of the Big Four state-owned banks. This coordinated effort to reduce counterparty exposure occurred against the backdrop of record inflows into gold, which now represents approximately 1% of the 166 trillion renminbi held in Chinese household savings. As the primary channel for gold exposure becomes increasingly restricted, the structural pressure is shifting toward the silver market, which lacks a comparable paper equivalent in the Chinese banking system. This sets the stage for a significant reallocation of capital as markets prepare to process the impact of the weekend's military escalations. The geopolitical landscape shifted dramatically on Saturday, February 28th, as the United States and Israel launched a comprehensive military campaign against Iran. Known as Operation Epic Fury in Washington and Roaring Lion in Israel, these coordinated strikes targeted military installations, missile bases, and government infrastructure across 24 of Iran's 31 provinces. Iranian state media has confirmed that the nation's supreme leader, Ayatollah Ali Khamenei, was killed during a strike on his compound in Tehran. General Abdul Rahim Musavi, the chief of staff, also perished in the operation. Furthermore, critical components of Iran's nuclear program at facilities in Fordo, Natanz, and Isfahan were struck, effectively implementing the terms Iran had rejected during the failed Geneva negotiations on February 26th. Iran responded with immediate retaliatory measures, launching drones and missiles at Israel and targeting United States military bases across several neighboring countries. Major transit hubs, including Dubai International and Abu Dhabi's Zayed International Airport, were forced to halt flights indefinitely following drone strikes. Central to the global economic impact is the effective closure of the Strait of Hormuz. The Islamic Revolutionary Guard Corps began broadcasting warnings that no maritime traffic would be permitted to pass through this vital corridor, which handles 20% of the world's daily oil supply and half of China's crude imports. The immediate financial fallout was visible when Gulf markets opened on Sunday. Saudi Arabia's Tadawul exchange dropped 4.8%, while the Kuwaiti exchange took the unprecedented step of halting trading entirely. In response, OPEC Plus convened an emergency session and agreed to a symbolic output increase of 206,000 barrels per day for April. However, analysts note that major exporters cannot actually ship this oil through the blocked strait. Consequently, Brent crude is expected to open significantly higher, with projections suggesting a potential spike above $100 per barrel. This sudden energy shock is expected to drive inflation expectations upward and solidify the role of precious metals as a primary safe haven asset. While risk assets like Bitcoin experienced initial volatility, falling to $63,000 before a partial recovery, gold maintained its upward trajectory. This sets a complex stage for the precise sequence of market openings scheduled for tonight and tomorrow morning. The global precious metals market is now entering a critical phase as the opening of the COMEX-Globex session at 6 p.m. Eastern approaches. This moment is particularly significant as it marks the first time institutional capital, with full accountability and margin requirements, will set an official exchange price following the weekend's events. While over-the-counter markets have provided indicative prices throughout the weekend, the COMEX Open represents the definitive transition to live exchange trading. This will be followed at 8 p.m. Eastern by the opening of the Shanghai Gold Exchange, which is primarily a physical exchange where contracts are typically settled with actual metal delivery. Given that Chinese domestic bank channels for paper gold are now largely restricted, the Shanghai Open is expected to reflect genuine physical demand rather than speculative financial activity. The sequence will conclude with the opening of the London bullion market at 3 a.m. Eastern, providing the first major institutional window for European and Middle Eastern sovereign wealth funds to respond to the regional strikes and the closure of the Strait of Hormuz. Structurally, the silver market faces unique pressures as it enters this delivery month. Registered COMEX silver inventory has declined to approximately 88 million ounces, a 75% reduction from its 2020 peak. This stands against theoretical delivery obligations estimated between 425 and 528 million ounces for the month of March. The silver market, which remains accessible even as gold channels are restricted in China, is seeing physical premiums in Shanghai reach $6 to $9 over COMEX futures. With global mine supply structurally limited and Chinese export restrictions in place, the physical supply needed to bridge this gap remains constrained. As the week progresses, we will continue to monitor the Monday delivery data and the evolving situation in the Middle East. The convergence of restricted banking access, a significant energy shock, and high delivery obligations on the COMEX represents an unprecedented set of conditions for the precious metals markets. We will return on Tuesday with an update on the first official trade numbers of the week. For now, I am OG John Original, and this concludes our special report.